Relevant revenues are a fundamental concept in management accounting and play a crucial role in commercial decision-making. Within the program framework, relevant revenues are future revenues that will change as a direct consequence of a specific decision. When managers evaluate alternatives, they must focus only on revenues that differ between options because these revenues influence the financial outcome of the decision. Revenues that remain unchanged regardless of the chosen course of action are considered irrelevant. Understanding the distinction between relevant and irrelevant revenues helps organizations make informed decisions regarding pricing, product mix, special orders, outsourcing, and resource allocation while maximizing organizational value. The principle of relevant revenues is closely linked to the concept of relevant costs. Together, they form the basis of incremental analysis, which examines the additional benefits and sacrifices associated with a decision. Relevant revenues are future-oriented and avoid consideration of historical transactions that cannot be altered. For example, revenues earned in previous periods are not relevant because they have already occurred and cannot be influenced by current decisions. Management accountants therefore concentrate on expected future revenues that arise specifically because a particular action is taken. This approach ensures that decision-making focuses on information that genuinely affects future financial performance. One common application of relevant revenue analysis involves special order decisions. Organizations may receive requests for additional business at prices different from their normal selling prices. In evaluating such opportunities, managers compare the additional revenue generated by the special order with the additional costs required to fulfill it. If the order produces positive contribution and does not negatively affect existing operations, accepting the order may be beneficial. The relevant revenue is the incremental revenue generated by the order itself, not the organization's total revenue. This distinction allows management to assess the true financial impact of alternative commercial opportunities. Relevant revenues are also important in product mix decisions where resources are constrained. When organizations face limiting factors such as labor hours, machine capacity, or material shortages, management must determine how to allocate resources among competing products or services. The relevant revenue associated with each alternative contributes to the evaluation of potential profitability. However, management generally focuses on contribution, which combines relevant revenues with relevant variable costs. By comparing the contribution generated by different products relative to the limiting factor, organizations can identify the combination of activities that maximizes overall financial benefit and resource utilization. Another significant application arises in make-or-buy decisions, outsourcing evaluations, and business continuation decisions. Managers assess whether future revenues will change depending on the option selected. For example, discontinuing a product line may eliminate certain revenues while freeing resources that could generate alternative income elsewhere. The relevant revenue is therefore not only the revenue lost from discontinuation, but also any new revenue that may be earned through alternative uses of resources. This opportunity-based perspective helps organizations evaluate decisions comprehensively and identify the option that creates the greatest overall economic value. In conclusion, relevant revenues are future revenues that differ between decision alternatives and directly influence financial outcomes. They form a key component of incremental analysis and support a wide range of management accounting decisions, including special orders, product mix selection, outsourcing, and business continuation evaluations. By focusing only on revenues that change as a consequence of a decision, managers avoid being distracted by irrelevant information and improve the quality of decision-making. When combined with relevant cost analysis, relevant revenue assessment enables organizations to evaluate alternatives objectively, allocate resources efficiently, and maximize profitability while supporting broader strategic objectives.